Henry Becker, Director of Research with Lighthouse Wealth Management, and this is our halftime update on the markets. I will apologize right off the bat for the lack of scenery or background that we have. Our offices are currently under renovation. We're remodeling a little bit, so right now the office is in a bit of disarray, so I used my office as the background. So again, my apologies. But let's get right into taking a look at where markets stood as of the end of May of 2018.
So to get things started, let's have a look at performance of global markets through the end of May 2018. So what we have on this chart is year-to-date as well as 12-month performance. So the S&P 500 large cap U.S. company stock index up 1.9. Russell 2000, which is a small cap index, up 7%. MSCI Europe Asia Far East Index, this is developed foreign markets, down 1.29. U.S. Aggregate Bond Index, which is a mixture of government, corporate, and agency-backed bonds, down 1.75. West Texas Intermediate, up 10.9, almost 11%, 38% over the last 12 months. Yes, we've seen higher prices at the pump. Bloomberg Commodity Index, mostly oil and precious metals, up 2.8. And then the Lighthouse Blended Index, up about 0.86. The Lighthouse Blended Index we use internally as a diversified portfolio of U.S. stocks, foreign stocks, commodities, and bonds. And we use this because not everyone has all of their money, almost all of our clients. It's safe to say that our clients do not have all of their money in U.S. stocks. Rather, they're in a diversified portfolio. So the blended index just gives us an idea of where a generally diversified portfolio would be. And then on the bottom we have interest rates, different rates. The Fed funds rate currently sits at 1.7 versus a year ago at 0.9. 10-year U.S. Treasury up, or is not necessarily up, but is at 2.7. It is up versus a year ago at 2.2. And then the 30-year conventional mortgage up a little less than 1% over the last 12 months.
So a few of the larger items that are driving global markets are oil prices, specifically geopolitics surrounding oil prices, interest rates, and the U.S. dollar. Well, let's talk first about oil prices. We've seen in the last 12 months oil prices have gone up pretty significantly, if you've noticed at the pump. A lot of this is driven by Trump deciding to leave the Iran deal. The Saudis and the Soviets, or Russians, they have curbed their production after we've seen inventories building up. They're now starting to come back down. And then on top of that, we have Venezuela production down. And we have a strengthening global economy, which is increasing demand. So we're seeing supply coming down and demand going up, which is going to move oil prices. Plus, we have the summer driving season in the U.S., which again contributes to price increases. But just like interest rates, if we see oil prices rising, this could put a bit of a slowdown on the economy, global as well as U.S. economy. But right now, we're not too concerned about it here at Lighthouse. Interest rates seem to be, or the economy seems to be digesting interest rates as it's been moving. They've been moving higher. And same with oil prices. We're not seeing any significant slowdown in the U.S. economy that would be attributed to interest rate and oil prices.
So what do we see in the markets right now? This first chart, we're looking at weighted global GDP and its annualized growth rate, GDP being gross domestic product. And we've broken it down by sections of the economy. Developed markets, this would be the blue section, which is the United States, Europe, Japan, Australia, Canada, and so forth. And then we have the BRICS, which is Brazil, Russia, India, China, South Africa. The major developing markets is the red. And then green is other emerging markets. This is where you're going to find places like Indonesia, Argentina, and so forth. And as you can see, obviously the 2008 crisis and the aftermath, the rip back, and we've kind of gone into more or less a channel, somewhere between 4 and 3% global GDP annualized growth. See a slight cooling recently, but overall, global GDP or economic health is in a reasonable spot right now. So from the U.S. perspective, using just one chart, what we're looking at is the S&P 500 earnings per share, and we can see that this chart, we've seen a steady rise, even though we had the interruption in 2008, the continuation of expansion in earnings per share for U.S. companies. So this is a positive. This is a good chart, and this basically outlines that the U.S. economy is still growing, and U.S. market is still growing in terms of the stock market. In our last slide, we have the VIX, the Volatility Index, which is a measure of the volatility in the U.S. stock market. And as you can see, from about mid-2016 until the beginning of 2018, we saw a steady slide in volatility, which means the markets were exceptionally calm over the last year and a half to 2 years leading up to 2018. Now, obviously, we saw a spike early on this year. Even though it's come back down, the average volatility index for this year is certainly greater than 2017 and probably on par with 2016. So while the current volatility might seem a little out of the ordinary, what was actually out of the ordinary was last year's exceedingly calm market.
So we see the U.S. stock market as being in the late stages of a bull market. Now, what can keep this bull market going? Well, there are a few things that we think will continue the bull market. One, and actually quite a few of these we're seeing right now. One, mergers and acquisitions. We are seeing a lot of mergers and takeovers. Share buybacks, the slow releasing impact, positive impact of tax reform as it's rolling through the economy, continued low interest rate environment, and the technological boom that we've been seeing. Now, obviously, the geopolitical environment that we're in can always put a kink in the system, but it seems like these things have been working themselves out and not having a huge impact on the market. So while the investing markets aren't going gangbusters, it's very likely that we're seeing the groundwork being laid for another move up in global equities. So, as always, if you have any questions, issues, or concerns, please feel free to reach out and contact us.